They're handing you a gift right now, and most retail traders are about to hand it right back, with interest. Bitcoin is trading at 73,812, and the chart isn't just bearish, it is architecting the most classic bull trap I've seen this quarter. There is one danger zone today that will wreck over-leveraged longs, and one hidden opportunity to ride a structural collapse. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can deploy right now. Whether you're a sniper, an active trader, or a full-on aggressor right now, the instant market verdict. The session bias is a fade. We are not chasing this bounce. We are selling into the rally until proven otherwise. The entire macro structure is heavy. The weekly chart is a strong sell. The daily chart is a strong sell. The 5-hour momentum is a strong sell, and only the hourly has neutralized slightly, which is exactly what gives the false sense of security. This is a dead cat bounce inside a bear flag. The one invalidation level that shifts everything for me today is $75,600. Write this number down. If Bitcoin closes a 4-hour candle above 75,600, the structure fractures. The bear flag invalidates, and we must step aside. Until then, I treat every tick higher as a short entry preparation zone, not a bull revival. Let's get into the deep technicals, and I want you to visualize this chart with me. Because what the moving averages are doing is not a suggestion, it is a brick wall. Pull up the daily time frame first. Price is buried. The 20-day moving average sits at 76,705. The 50-day is at 76,200. The 100-day is at 76,685. And the 200-day moving average, the granddaddy of trend health, is way up at 81,548. Bitcoin is trading $6,000 below its closest significant daily moving average. This is not a dip you buy with conviction. This is a bearish expansion that has broken the entire structure of the daily trend. The moving averages are beginning to fan out negatively. The MA20 has crossed below the MA50, and the slope is aggressive. That is a death cross dynamic playing out in slow motion. On the weekly chart, we have a strong sell signal that has trapped any late cycle longs who bought the 80,000 level. The weekly MACD is deep in negative territory, and the histogram shows no signs of a bullish reversal. If you zoom into the 4-hour time frame, you see the bear flag. We had the sharp pull down from 77,000 to the 72,600 support. Now we are grinding up on declining volume, retesting the broken support-turned-resistance zone right around 74,586. This level is magnetic because it aligns with the hourly MA200 and day. Previous breakdown point. Buyers are exhausted. Look at the RSI on the daily. It's buried at 36.54. That is not oversold enough for a V-shaped recovery. That is a reading that says any bounce is a trap until RSI can reclaim 50. The MACD line is at minus 782. The signal line is falling, and there's no bullish divergence. You don't catch a falling knife when the momentum is this negative across all high timeframes. Here's what most traders miss. They see the bounce from 72,600 and think it's the bottom. It's not. It's the construction of the lower high. The key resistance stack is brutally clear. The first resistance is 74,586. Above that, we have 75,566. Which is the prior swing high that must hold for the bear flag to remain valid. The support structure is equally defined. The first support that matters today is 72,608. That was the demand zone that halted the last cascade. Below that, the next liquidity void sits at 71,611. If 71,600 breaks, the measured move of the bear flag takes us down to the 68,000 handle. That is where the volume profile shows a high volume node, and that is the real battle zone. But today, the immediate fight is at the 74,600 resistance wall, and the moving average coffin. Corner right above it. Now, let's move into the fundamental driver and the cross-linkage, because Bitcoin is not moving in a vacuum, it is moving as the risk asset shadow. If you've been watching the S&P 500, and you should be, it's struggling with its own 50-day moving average. The correlation is tightening. Bitcoin is behaving as a high beta play on the liquidity tide. Yesterday, the bounce started right as the S&P futures caught a bid in the short-term oversold condition, but the macro backdrop hasn't changed. The institutional positioning shift is critical. We are seeing ETF flows flatten out and, in some sessions, turn negative. The spot buying that drove us to all-time highs earlier has vanished. On-chain, short-term holders are underwater, and their cost basis is now acting as overhead supply around the 77,000 area. Meanwhile, the funding rate landscape tells us everything. Funding rates are neutral to slightly negative. In a true bull market, you'd see positive funding on a bounce. The fact that we can't sustain positive funding here tells me that conviction is absent. This is a short squeeze bounce that sets up the next leg down. The narrative web is tight. If the S&P 500 cannot reclaim its 50-day moving average today, Bitcoin will get rejected at our 74,600 resistance. The cross-check with gold is fascinating too. Gold is holding firm as a fear architect, signaling that real yields and geopolitical anxiety are still dominating the macro conversation. Bitcoin is not behaving as digital gold right now. It is behaving as a levered Nasdaq proxy. So, my 1 to 2 week directional lean is firmly bearish. I expect a rejection at the current resistance cluster, followed by a sweep of the 72,600 low, and eventually a test of 71,600. The event that would invalidate this thesis is a daily close above the 20-day moving average at 76,705, or a sudden dovish pivot from the Federal Reserve paired with massive spot ETF inflows. Until then, I sell rips. Most people will skip this, but this is where money is made. Keep watching. We are about to go through the 3 specific trade setups for today. But before we do, let's see how aligned we are. Type your Bitcoin range for tomorrow in the comments right now. The high and the low you expect. I'm reading them, and it's the fastest way to calibrate your own bias against the institutional flow strategy one, the sniper. This is the conservative setup, designed for patience. You are waiting for the price to prove it cannot escape the bear flag. Your trigger condition is this. We need Bitcoin to rally into the resistance band between 74,586 and 74,650. That is the resistance wall aligning with the hourly MA200 and the flag top. You do not just market sell at the level. You wait for a 15-minute or 30-minute bearish engulfing candle, or a clear wick rejection with a strong close back below 74,300. That is your entry trigger. Place your stop loss at 75,700. The logic is simple. 75,700 is above the structural swing high of 75,566. If the market trades there, the bear flag is breached, and the trade thesis is dead. Your target 1 is 72,650. That is just above the major support, giving you room for a reaction. Your target 2 is 71,700. The risk-reward on this sniper entry is excellent. You're risking roughly 1,000 points from a 74,600 entry, aiming for a move of 2,000 points on target 1, giving you a 1 to 2 risk-reward ratio. Target 2 extends that toward 1 to 3. If the price fails to reach the zone and starts rolling over from here, the sniper does not chase. You stay disciplined. Strategy 2, the active trader. This is the standard setup for those who want to participate without waiting for a perfect wick. The entry condition is a clean breakdown of the hourly trendline support that is forming the lower boundary of this bear flag. On a 60-minute chart, draw a trendline from the 72,600 low to the recent higher lows. A decisive hourly close below that trendline, roughly around 73,300, is your trigger. You enter on the retest of the broken trendline, expecting it to act as new resistance. Alternatively, if we spike into the 74,300 zone and the 15-minute chart shows a momentum divergence with the RSI failing to make a higher high while price grinds up, you can initiate a short there with the same logic. Your stop loss sits at 74,700, just above the intraday swing high and cleanly above the resistance cluster. The reasoning is structural. If buyers can push through 74,700, they're aiming for the 75,500 resistance, and you don't want to be short. Your target one is 72,620, just above the major support. Your target 2 is 71,650. Once target 1 is hit, immediately move your stop loss to your entry point, making it a risk-free trade. Then, trail the stop using the 15-minute 20-period moving average as your dynamic exit trigger. This way, if the 72,600 support shatters, you ride the waterfall down to 71,600 without giving back profit. Let's see how aligned we are. I asked for your range earlier, but now type bear flag in the comments if you see the exact same pattern. I want to see if this community is reading the chart structure correctly. Strategy 3, the aggressor. This is the high risk, high reward. Momentum fade for those who know how to lose small and manage risk aggressively. We are treating the current zone, 73,800 to 74,100, as the active resistance short zone, particularly if a quick spike fails to hold above 74,000. The entry is a limit or market order on any sudden pop that gets instantly rejected at the 74,000 psychological level and the MA5 resistance at 74,643. You use a very tight stop loss at 74,390. That is just above the local liquidity grab level. If the price trades above that, you are wrong and you get out immediately with a small loss. The logic here is that an impulsive breakout beyond the flag structure is unlikely, and the market makers are hunting stops above the hourly consolidation before the real move down. Your target one is aggressive, 73,100, which is the midpoint of the flag. Your target 2 is 72,650. The risk is 50 to 60 points of stop hunting versus a potential 600 to 1,000 point reward. But I'm serious, this is only for traders who accept that a false breakout can happen and who will execute the stop loss mechanically, no hesitation. The invalidation for this aggressor setup is any prolonged 30-minute candle close above 74,600. If that happens, the trap sprung on you. Not on the bulls. Accept it and move to the sniper approach. Before we move on, a quick risk management pulse. Never risk more than 1 to 2% of your account on any of these setups. Do not hold positions through high-impact economic news events that can trigger violent short squeezes. Stops are non-negotiable. You exist to trade another day. Alright, let's close this out with the retention loop and the one level you absolutely must watch. The most critical level for the next session is 74,586. If that level holds as resistance and we see a reversal candle, the bear flag is validated, and the path to 72,600, then 71,600, is wide open. If it breaks and we get a 4-hour close above 75,600, the structure shifts entirely and we pivot to neutral. Tomorrow, we are watching the US personal consumption expenditures data, which will completely reshape the dollar and risk appetite. The Bitcoin reaction to that data will determine if the bear flag morphs into a breakdown or a fake-out. If you want the full breakdown on the S&P 500 divergence and how it's dragging Bitcoin, that video is live now. Check the end screen. Smash the like button if this analysis gave you a clear, actionable plan for Bitcoin today. Subscribe, hit the bell, and I'll see you in the next video, same time, covering the exact intermarket forces that print the next big move. Stay sharp.